Secretary Blinken said that the United States and its allies are seriously considering banning Russian oil and natural gas imports. WTI crude futures traded as high as $130.50 a barrel at one point overnight. Let's bring in Rob Raymond. He is the founder and principal of RR Advisors. And Rob, maybe not a huge surprise to hear the United States and its allies are talking about this at this point, but it has put some serious pressure on prices. What would you do at this point, looking at crude oil and trying to figure out if you were going to trade this market, what you would do?
Yeah. So good morning. We're obviously in a tough spot here. I was on your show back in September, and we talked about a lack of capital investment and how that was effectively serving to tighten the market relative to what was proven to be very strong demand. And so we're now in a position here where oil prices are, call it generically, inversely correlated with excess global capacity. So what does that mean? It means as excess global capacity goes down, as the market perceives that's the case, oil prices basically do the opposite. They go up. And so unfortunately with the Russia situation, which I would comment nobody on the oil side that I know really wants, this is obviously highly disruptive and not at all favorable. We're running the risk of taking 3 or 4 million barrels a day out of the global market relative to Russia. And so excess global capacity, if that happens, basically goes to zero, or if there is such a thing, a negative number, which in turn means prices basically have to go to a level to ration demand. So there is no ability to step into the market from a supply standpoint to really manage the loss of what could be a significant portion of excess global capacity. And so you see, the administration now talking with the Venezuelans, you see them trying to figure out something with the Iranians, et cetera. They're grasping at straws at this point. Again, with the real issue being that what is grounded in all of this is the idea that global investment has collapsed post-COVID, and frankly, it was already starting to happen pre-COVID. And so the only real answer, we're going to be in the soup here for a while, if you will, with the only real answer being we've got to get back to investing capital on the upstream side of the global industry.
Rob, what do you think of the idea of trying to cut a deal with the Venezuelans or the Iranians? Could that help in the short term?
Yeah, maybe on the margin. The problem in Venezuela, I think, is we're back to the lack of capital investment. Obviously, that's been, put it nicely, a suboptimal situation for many, many years, which means not a lot of capital has been invested in what has historically been relatively dilapidated and very expensive infrastructure. So I suspect that when we go to Venezuela, we're going to find out that whatever everybody's expectation of productive capacity really is some number less than that. And the problem with the Iranians, I suspect, is they've probably been smuggling crude into the market anyway. So I don't know that they've got as much spare capacity sitting offline as everybody thinks, number one. And number two, you've got a real quality of crude issue in both of those countries. So a lot of very sour, in some cases, very heavy barrels. And the problem with that is it's just not applicable to go put those barrels in any refinery anywhere in the world. So it becomes a very selective problem in terms of where those slates of crude really go.